has been on a major run, as we all know. So the thing is, why should anybody move their money when everything seems to be working? It's a good question. In a perfect world, we all want to get out of the roller coaster at the end. The thing is, you never know when the top is going to come in the market, but you have to be prepared to look for the visual signs. And so we have to train ourselves to identify when this great marathon in the market is going to be over. So when is this market going to be over in terms of the marathon? That's very hard to tell, like I said. And the fact of life is we are always going to be trading blind in the market, just because that's the nature of the beast. And so you can see that even though we are trading every day like today, nobody knew where the market was going to close, up or down. Always very confusing. I don't remember a time ever when the market gave us a clear signal to go long or to go short. People say it's a buyer's market, seller's market, risk off, risk on. I mean, all these are just things we all say, but ultimately, whenever we place a trade and hoping we get the direction correct, but we never know where the market is going. So we trade blind, and that's just how trading is. But we need to have tools that can help bring some light into what we are doing and shed some, give us some direction of where the market is leaning. And that's the kind of thing I'm talking about here. Just have a sense of where the market is going visually. Okay, this is a chart for the S&P 500 since March 2009. The market is up 156 points. And so, of course, the big question here is, are we going to be moving beyond 1700 on the S&P 500? Is this market oversold? Should we stay long? These are very important questions, because if we're going to make money, we need to be able to identify major turn points. Now, if the market goes down 2-3% and then continues making highs to 1700, 1800, then, it's okay to stay long. But what if the market has the next big move, market ends up trading, 1200 or 1300? We want to be prepared for things like that. And this webinar is going to tackle that very important question of where the market is trading at right now. So let's take a look. Let's go back. This is the market in 2007, 2008. And as you can see, this was a major high in the market, late 2007, 2008. And it would have been very nice for all of us to have been able to know that the market had peaked at the time. Of course, we have the luxury of looking at the charts in hindsight right now, but this webinar will try and make it easier for you to have seen the highs of late 2007, and also what were the red flags that the market was showing. And this webinar is going to be discussing that. Let's take a look at a stock like Priceline. This monster stock has been up almost 2,000% since the 09 lows, 08 lows. An amazing moving stock. Of course, if you're long the stock, you'd like to know whether you should stay, for the stock to break 1,000, or if you want to go short this major mover, where do you go short? So that's what this webinar is going to be discussing, such major movers in the market. Like I called this webinar the market's best moving stocks, when to sell them and when to get out or when to go short. All right, let's take a look at Apple. Now, right off the bat, I'm sure most of you don't notice this, but this is a weekly chart, and it shows the move in Apple from 2003 to 2008. Now, good for almost 1800% in 4.5 years. A big move. So could the things we're going to learn today have helped you lock into this profit before the drop in 08? So that's what we are trying to learn here. So could what we're going to learn today have helped you stay in this stock for as long as possible? And could the tools and the visual aspects I'm going to be discussing here, would they have helped you to get out of this stock or to short the stock in late 07 or early 2008? All right. Now, again, the same stock, but now we are looking at it from the current market. Of course, Apple peaked in 2012, and this is a current chart. So yeah, after a 600% gain since the breakout in 2009, this is what the chart looks like. Of course, the stock's been down. Everybody knows that. People are interested to know whether they need to get back in the stock. I'm not going to necessarily be covering whether it's a buy right here, even though I do discuss that, and I'll tell you when. I do that in a follow-up to this webinar, is what we are going to learn today. Would this help you to get out of this stock above 700 or closer to 700 as possible? All right, so let's take a look at another stock here, and it's for silver. Silver had a major run, 2010-2011 time period, breaking out here from about $17, $18 and going all the way to 45. Now the arrow I show here is where we went long this name or silver about 2010. So again, what I'm looking to try and show you here is that there are methods we can use to get out of this major market moves with a profit, lock in a good profit, or initiate a short position. Everybody right now wants to know about Tesla. Stocks trading at about 170, give or take. Everybody wants to know, they short the stock, where do I get out if I own any stock? So what I'm saying here is we're going to try and see whether we can find a way or a method that can visually, using the three aspects I talked about at the beginning, that can help us get out of this name whenever the time is going to be ripe for us to get out of this name. Now, of course, technical analysis as a science is not perfect. So just understand that even though it is a method, like any other scientific method, it does have its own issues. There's going to be some adjustment and some level of learning curve. Just like Kyle said, you do need to study these things. What I'm showing you here is just a summary. And remember, this is what I do every day. When you become a subscriber, this is what I do for you in the back. I look for ideas for us to go long, go short whenever the opportunities are right. Okay, so we are going to try and combine simple factors. And when it comes to time to implement what we're going to be learning here, sometimes it's going to take one red flag to go short a stock. And sometimes it's going to take a combination of one or two of the red flags we are going to be talking about. Keep in mind, let me go back there. At the end of the day, remember, as traders, we are going to always be trading blind. And what I'm going to be showing you is not a perfect science, but just a visual tool to help us understand how to use the monthly and weekly charts to get out or in of a stock, or to get out of a stock if we own it, and to get in terms of shorting the stock or selling the stock for a profit whenever it's time to go short. So drum roll, please. Okay, so why don't we go to the meat of this webinar? And on a weekly chart, the very first red flag is a failed weekly breakout. And what I mean by that is, after the market has made a high in the price on a weekly chart, give it about 2 weeks of rest minimum, and then it tries to move to new highs and subsequently fails. Once it moves below the previous weekly closing high, you want to use that as your entry point to get out, or as your reason to go short. So that's the first red flag right there. Okay, so let's move on here. So now the red arrow number 1 is where the breakout fails. And the arrow number 2 is when the stock moves below the 10-week moving average. Now I have to talk about the fact that, so the stock fails to break out, moves below the 10-week moving average, settles down for at least 1 week, which is the black arrow, and then the subsequent move lower, which is the next slide. As you can see now, the purple line here, this is where you want to short the stock. So we have a move below the 10-week moving average. The stock settles down, tries to rally back above the 10-week moving average. So that's the second red flag. Remember the 3 visual aspects. This is the second one of the 3. Okay. So now point number 2 is where you want to go short, or where you want to get out of your position, because you have 2 red flags. A failed breakout now, move below the 10-week moving average, and a fresh break of that recent closing low on the weekly chart. So let's move on here to the next one here. And it is now I'm giving you the third red flag. As you can see, the third red flag is the crossover between the 13-week moving average or the 33-week moving average. Now, on the slide, I show the 10-week moving average or the 34-week moving average. It doesn't really matter. They're pretty much the same. I use either, and you can use either, but it doesn't matter. The most important thing is that crossover between the 13-week moving average and the 34-week moving average. And you can see there's a green arrow at the bottom there. That's when there was a buy signal to go long. And this is a multi-week, multi-month setup situation. So once you see that crossover for a stock you own or for a stock you want to short, this is where you want to initiate your short position. So we've covered those three red flags. They're very simple. Sometimes you have to use one, sometimes a combination of one of the three. Okay, today we know we are all beginning the new season for the NFL. And as you can see, it doesn't come very easy for somebody to stand in front of a podium and be announced as the champion. Think of all the effort, the planning, adjustments it takes for any team to become champions of any event. Think all the plays or the setups that these players have to memorize and all the adjustments they have to make up throughout the season. It's just like, in a way you look at it, it seems like that's what we have to do as traders. We experience challenges, situations change, but ultimately we have to keep a goal. We have to keep working hard. And in this particular example, I liked using this NFL as an example because they do have visual plays, they have plays. And so I have shown you three ways you can short winning stocks or get out of a market, general market, or to go short a general market, or to go short a stock. And this is going to work in any market anywhere in the world. So just keep that in mind. So let's go back here and just to go back and revisit what I just showed you in a quick minutes here is you'll notice points labeled A, the 3 points labeled A, and I'm going to show next slide. Those who are where you should have initiated your short position. And now I'm going to show them with the arrow there. Okay. Now I don't show the very top. The top failed breakout was also an entry point. The failed breakout was an area to go short or get out of your long position. Of course, you see the first red arrow was a point to get short or get out because it was making a fresh short-term weekly low. And then the second arrow in the middle there was another entry point to the downside. And of course, the third arrow is another entry point to the downside. Hope you can all see that. Same thing here. Now, the thing I want to talk about on this slide is initially it's not very obvious, but what we are playing here is the band of that 10-week moving average or the band of the 13-week moving average. Once it starts rolling over is when you start anticipating visually that the market is running out of steam and that the market needs to be faded or needs to be sold. So we are playing the fade or the band of the 10-week moving average because we see that down the road with every subsequent break of the weekly chart, every subsequent move lower means that the 10-week moving average is going to bend, and ultimately we are going to get a crossover between the 10-week moving average and the 34-week moving average, which is, like I said, a major sell point in any stock that has been doing well or a major sell point in any market that has also been doing well. Okay, like I said, it's not a perfect science, but we're going to take a look at some examples here. The one thing I can say about this method, when I use it, and if you start using it, or at least if you start insisting that you see this method before you go short a winning stock, you know, like Priceline or Tesla or even Facebook that is doing well and many other stocks that are doing well, is because you have an expectation for the stock to show you the band of the 10-week moving average, failed breakout, fresh move to weekly lows. It buys you reason to be patient. It forces you to be patient and it forces you to have some timing aspect. So if you bring patience to your trading and if you bring some level of timing, you're going to make mistakes. Yes, we all do. In other words, it's not mistakes, it's just that the market decides to go the other way. But it buys you time to be patient and it also helps you with your timing. Okay, so let's begin here by taking a look at the S&P 500, and I'm going to take you back to 2007, 2008. And you can see the topmost arrow. The market had tried to break out above 1550 on the S&P and failed. So that was our first major inkling that the market was not healthy. That failed breakout would subsequently, as you can see here, there was a crossover. This arrow, the arrow here with an X shows a crossover point. That was another indication that the momentum was changing. Notice that the 10-week moving average was already bending. And I also have to note that by about November, December of 2007, even the moving averages were making multi-month lows. Another red flag there. But the best break comes late 2007 when the market moves to new weekly closing lows. So by the time we begin 2008, the market had already flashed our three visual signs to get out of a strong market. Okay. Also notice here that in 2008 May, the market did try to take back that break point and failed. And that also happened to be a very nice point of going short the market at that time. Let's take a look at another example. And it's just an example I picked out. This is an example for Boeing, 2008. Notice it broke down and failed to hold a breakout level when it tried to move above 103, somewhere in that area. It failed, so that was your first red flag. It then had two down weeks that moved it back below the 10-week moving average. Notice that the 10-week moving average starts bending, and then we have the crossover between the 10-week moving average and the 34-week moving average. And then the lines I show in red there, the horizontal lines that I show in red, they are the breakpoints to new weekly closing lows. And every break of those lines shows that it was a nice time to get out of the stock or to initiate a short position. So as you can see, the things that we are learning here or discussing in this webinar could have helped you get out of Boeing in 2008 before this major drop. Let's take a look at a world market here, and it is for the Brazilian market. Now the Brazilian market, as early as July of this year, was down almost 41% from the 2010 highs. That's an amazing drop. Remember, world markets have been close to all-time highs. The US market has been leading the world market as it was trading and is still trading close to all-time highs, but the Bovespa has not followed through. If you go back to 2010, late 2010, notice the failed breakout in October, November time period. There was a failed breakout. On the weekly chart, it failed to break out again in the beginning of 2011. That was another red flag, reason to get out of that market or to be very cautious. Remember, the stock had had a nice run from the lows of late 2008 and now was showing failed breakouts late 2010, early 2011. Notice now that we come and form a bending 10-week moving average. We also have bearish crossover between the 10-week moving average and the 13-week moving average in April of 2011. And then there was a weekly break point sometime about May of 2011. And once it broke down there, that was a nice time to have gone short the stock. And actually, it had a very big drop in terms of percentage, moving from about 65,000 to as low as 47,000. So big drop. So that is the kind of move I'm talking about. And using what we talked about here, you would have been out of that market. It would have been very obvious that you needed to be out of that market. Okay, let's take a look at Apple 2013. This is a current chart on a weekly basis, and you see that there was a failed breakout sometime in October of 2012. This failed breakout, after it had broken out in August 2012, made new highs above about very close to 700, but eventually broke down. Now, once it breaks down below that red line there, that's the topmost red arrow, is where you would have gone short the stock or at least got out of the position because the breakout was failing. Okay, so notice how the 10-week moving average really bends for Apple, and then the crossover takes place at about 575, somewhere around there. So as early as, let's call it December of last year, this stock was a sell. So you would have really been out of the stock and saved yourself a lot of trouble. You would have shorted this stock. And you can also, now I was publishing a lot of videos on YouTube discussing this idea because I know it's very popular, and I talked about the fact that I thought the stock was in trouble and it did fall, not because I'm a genius, but because it was meeting some of the requirements we are talking about here. So notice the weekly break point took place here in December. There was a weekly, this arrow here I show in December, November timeframe. Apple broke down there and never recaptured that red line. It broke again beginning of 2013, and it's never been back to those levels since then. So this is the kind of thing I'm talking about. Okay, so let's move on here. Most recently, stock that was doing the same thing was IBM, and I posted this. This is just from my stock tweets account. And the reason I'm just showing you that this is something I use and it works. IBM was trading at about 191. Show you the weekly. Notice the weekly here for IBM, and the reason why I thought it was a short. Failed breakouts early on in spring here, failed breakouts above, let's call it about 208. It failed to hold those levels. So it was a first red flag. There was a crossover, bearish crossover between the 10-week moving average and the 13-week moving average. And then there's also the bending of the 10-week moving average. So all those things, and not forget this major trend line, the gray line. IBM was breaking below that. So my price target for this stock, quite frankly, is about 156, which would be 61% retracement from the lows of late 2008, 56, 156, or maybe a secondary price target of 138. Okay, let's take a look at one more IBM chart. It's a current chart here. You can see ever since I posted that, it's really been getting very close to this 170s level. So it's taking place. It's breaking down very slowly. We see now that the crossover has been confirmed. Everything here points to IBM for now, showing that it is really going to be weakening over time. Okay, so now this is the current chart for the S&P 500. I saved this a couple of days, so it doesn't reflect today's closing price. But you'll notice that as of right now, the S&P 500 is starting to show an early sign of a bend. Now, the market has not turned bearish yet. Why? Because we haven't seen the crossover of the 10-week moving average and the 34-week moving average. Until we see that crossover, we cannot necessarily become very bearish as far as this name is concerned. So let's also just remember that we are seeing the first sign of trouble here for the market with this bending of the 10-week moving average. There was also a failed breakout, and let me show you the same chart but now from a closer perspective. And this is the S&P 500 weekly chart again, but shorter time period. This is just for the the calendar year 2013. Notice that we have a failed breakout to hold 1667. The market failed there. That was our first sign of trouble once it failed there. And then it settled down at 1655.83, tried to rally, and then came back and broke that. Once it broke 1655, that was another sell point or reason to get out of the market. Right now, the lowest weekly close for this year is 1632. What I'm saying here is if the market breaks below 1632 on the S&P 500, at some point, that would be a time to initiate short positions again. So watch this level, 1632, for indication of where this market wants to go. If the market recaptures 1653 or 1667, the previous failed breakpoints, then maybe we might start warming up for the market to move higher. Okay, so as of right now, given this chart in front of you, would you short this stock? Now, I hope the answer is no, because we don't see any failed breakout. We don't see any bending of the 10-week moving average. We don't see none of that. So be patient. If you want to short this stock, just let it do its own thing. At some point, it's going to become a short. So, that does get very close to the conclusion. Hey, Kyle. You there, Kyle?
Yeah.
Hey, okay. Hey, I want to point out I recorded an hour-long video, very detailed video, which is going to be part 2, a continuation of this webinar, because there were so many examples. In part 2 of the video, and if you're a subscriber, you're going to get this video. It's going to be uploaded immediately after this webinar is done. I'm going to send this video to all my subscribers. I'm going to go into detail with lots and lots and lots of examples